Silver is no longer moving quietly. It just made one of the sharpest upward moves we've seen in months. But here's the real question. Is this the beginning of a structural breakout fueled by sticky inflation and rising geopolitical risk? Or are investors misreading short-term volatility as a long-term shift? A hot inflation print, shifting rate expectations, tightening supply dynamics, industrial demand growth, and a controversial trading halt all collided at once. When monetary pressure and global uncertainty align, markets don't drift. They reprice. If you're watching silver approach the $100 psychological level, you need to understand what's actually driving this move, because the difference between a breakout and a spike is everything. When silver moves sharply higher, the first instinct is to search for a single trigger. Was it inflation? Was it geopolitical fear? In reality, the strength in silver came from a convergence of both forces at the same time, and that alignment is what made the move so powerful. The hotter-than-expected Producer Price Index report immediately shifted inflation expectations. Producer prices running above forecasts signal that cost pressures are still present in the system, particularly in services. That matters because inflation at the wholesale level often works its way through supply chains. Markets do not wait for confirmation at the consumer level. They reprice future risk the moment upstream pressure appears. When inflation surprises to the upside, investors reassess the purchasing power of cash and the likely path of interest rates. If inflation proves sticky, the probability of sustained higher rates increases and uncertainty around monetary policy deepens. Precious metals, especially silver, tend to respond positively in that environment because they serve as a hedge against currency debasement and policy unpredictability. At the same time, geopolitical tensions added a second layer of demand. Travel advisories and elevated risk headlines do not need to translate into immediate conflict to influence markets. What they do is widen the range of possible outcomes. When uncertainty increases, institutional risk managers adjust portfolios defensively. That often means allocating capital toward assets perceived as stores of value. Silver, despite its industrial role, remains firmly embedded in the precious metals complex and benefits from safe haven flows during periods of global stress. The key point is not that either inflation or geopolitical risk alone drove the move. It is that both forces were pulling in the same direction simultaneously. Inflation created the macro foundation by challenging rate cut assumptions and pressuring real purchasing power. Geopolitical risk acted as the accelerant, increasing urgency and defensive positioning. When these dynamics align, price does not grind higher. It reprices quickly. This dual catalyst explains why the move felt sudden. Markets are forward-looking mechanisms. When monetary pressure and geopolitical uncertainty converge, capital rotates fast. Silver's reaction reflects that intersection of macroeconomics and risk psychology, not randomness. A single inflation report can change the tone of the entire market in a matter of minutes. That is exactly what happened when the latest Producer Price Index came in hotter than expected. On the surface, a few tenths of a percentage point may not look dramatic. In reality, those small deviations from forecasts can force a rapid reassessment of interest rate expectations, and that is where the real impact begins. Producer prices sit upstream in the economic pipeline. They reflect what businesses are paying for goods and services before those costs reach consumers. When producer inflation runs above expectations, particularly in the services component, it signals that pricing pressure is not fully contained. Markets understand that persistent cost pressure at the wholesale level can eventually filter through to consumer prices. Investors do not wait for that second confirmation. They adjust positioning immediately. The key shift was not just about inflation itself, but about what it implied for monetary policy. Prior to the report, many participants were positioned for a smoother path toward rate cuts. A hotter PPI disrupts that narrative. If inflation remains sticky, central banks have less flexibility to ease policy. Even if rates do not rise further, the possibility of them staying higher for longer becomes more credible. That shift in the expected rate path changes asset pricing across the board. For precious metals like silver, this dynamic is critical. Higher for longer rates create uncertainty about real yields, currency stability, and long-term purchasing power. Investors begin to question whether holding cash or fixed income assets fully protects them against inflation risk. Silver, as both a monetary and industrial asset, becomes an attractive hedge in that environment. It benefits from the perception that it can preserve value if inflation persists, while also retaining industrial demand support. The speed of the market's reaction also suggests that positioning was leaning the wrong way. When traders expect softer inflation and instead receive a surprise to the upside, they must quickly adjust exposures. That adjustment can involve covering short positions in metals, adding hedges, or reallocating capital toward hard assets. Rapid repositioning amplifies price movement beyond what the raw data might justify on its own. This is why the inflation surprise mattered so much. It was not simply a data point, it was a narrative shift. It forced the market to reconsider the timeline for rate relief and to reprice the risk that inflation pressures are not yet finished. Silver's reaction reflects that repricing of expectations rather than a sudden change in long-term fundamentals. If you only look at silver as a safe haven metal, you miss half of the story. And if you only look at it as an industrial commodity, you miss the other half. The real power behind silver's price behavior comes from the fact that it sits at the intersection of both worlds. That dual identity is not a marketing angle. It is a structural reality that shapes how capital flows into the market. On the monetary side, silver trades alongside gold as a hedge against inflation, currency debasement, and policy uncertainty. When inflation surprises to the upside or rate expectations shift, investors look for assets that are not directly tied to fiat purchasing power. Silver benefits from that reallocation. It may not carry the same central bank reserve status as gold, but it is deeply embedded in the precious metals complex. When defensive positioning increases, silver often rides that wave. At the same time, silver is an essential industrial input. It is widely used in electronics, semiconductors, solar panels, data infrastructure, medical devices, and automotive applications. Its high electrical and thermal conductivity make it difficult to substitute in many advanced technologies. This means that silver demand is not purely sentiment-driven. It is tied to real production cycles and long-term technological expansion. What makes this combination particularly powerful is how the two demand streams can align. In a scenario where inflation is sticky and geopolitical risk is elevated, monetary demand rises. If industrial production remains steady or continues to expand, particularly in sectors like renewable energy and electronics, industrial demand does not fade. Instead of one side offsetting the other, both forms of demand can stack. This stacking effect increases price sensitivity. When safe haven buyers enter the market, they are not displacing industrial users. Industrial participants still need material for manufacturing processes. That overlap tightens the available float and amplifies price reactions to new information. This dual demand structure also explains why silver can be more volatile than gold. Gold is primarily monetary. Silver carries that monetary component but adds cyclical exposure. In risk-on periods within the metals space, investors seeking higher beta often gravitate towards silver. In risk-off environments, it still attracts defensive flows. That flexibility allows silver to respond quickly when macroeconomic and industrial trends move in the same direction, creating sharper and faster price adjustments than a purely defensive asset would typically experience. When silver suddenly accelerates instead of climbing steadily, that type of move usually tells you something important about positioning. Markets rarely surge in a straight vertical line unless traders were leaning the wrong way beforehand. The sharp elevator move suggests that expectations going into the inflation report were misaligned with the outcome, and once the data hit, participants were forced to react quickly. Before the release, a significant portion of the market appeared to be positioned for softer inflation and a smoother path toward rate cuts. That kind of consensus creates vulnerability. When positioning becomes crowded, it does not take a massive shock to trigger outsized price reactions. It only takes a deviation from the expected script. The hotter-than-anticipated producer inflation numbers disrupted the prevailing narrative, and when narratives shift, money moves. Short sellers are often the first to feel pressure in that environment. If traders were positioned for metals to drift lower or remain contained, a surprise inflation print would immediately challenge that view. As price begins to rise, short positions start accumulating losses. Risk managers step in, margin requirements tighten, and traders cover to limit exposure. That covering activity adds fuel to the rally. What begins as a data-driven reaction can quickly evolve into a positioning-driven surge. At the same time, long-only funds and macro investors reassess risk. If inflation appears stickier than anticipated, portfolio hedging becomes more urgent. Allocations toward hard assets increase. When both short covering and fresh buying occur simultaneously, price can jump much faster than fundamentals alone would justify in that moment. This dynamic explains why the move felt abrupt rather than gradual. It was not that silver's long-term outlook transformed within an hour. It was that the market's expectations had to be recalibrated quickly. Expectations, not just economic data, drive price behavior. When traders are wrong-footed, they do not exit calmly. They adjust aggressively. The speed of the move is therefore less about panic and more about structure. Modern markets are heavily leveraged and increasingly automated. When triggers are hit, whether through stop-loss levels, algorithmic signals, or volatility thresholds, execution happens instantly. That creates the visual effect of an elevator rather than a staircase. In silver's case, the sharp rally reflects how sensitive positioning was to an inflation surprise and how quickly capital rotates when consensus proves incorrect. Few things trigger speculation faster than a trading halt in the middle of a volatile session. When the primary metals futures exchange experienced a temporary interruption during an already sensitive market window, it immediately amplified suspicion. In fast-moving environments, participants are already on edge. When price discovery pauses unexpectedly, the natural reaction is to question whether something deeper is happening behind the scenes. It is important to separate emotional response from analytical assessment. Exchanges occasionally halt trading due to technical issues. Modern financial markets rely on complex infrastructure, matching engines, data feeds, clearing systems, and those systems can and do fail. A disruption lasting roughly an hour and a half is disruptive, but disruption alone does not equate to manipulation. The presence of chaos is not proof of intent. The speculation intensified because heavy selling was observed around key price levels during that broader time frame. To many traders, that sequence felt too convenient. However, large sell waves can occur for entirely conventional reasons. Producers may hedge forward exposure when volatility rises. Funds managing diversified portfolios may liquidate positions to raise cash if other assets decline. Algorithmic systems may execute automatically when predefined price thresholds are breached. Options dealers may dynamically hedge exposure near significant strike levels, buying and selling futures mechanically as price moves. Each of these explanations can generate rapid and concentrated volume without any coordinated attempt to suppress price. High volume during a volatile session also requires context. Futures contracts can change hands multiple times in a single day. Reported ounces traded represent turnover, not physical metal moving from vault to vault. Elevated volume indicates repositioning and uncertainty. It does not inherently reveal motive. Another critical point is durability. If a market were successfully defended at a specific level through artificial pressure, price would likely remain pinned. In this case, silver rebounded and continued trading above prior levels. That behavior weakens the argument that the halt itself determined the trajectory. The more constructive takeaway is not whether the event was suspicious, but what it revealed about market fragility. When inflation surprises and geopolitical tensions are elevated, participants are already leaning toward caution. A technical disruption during such a period magnifies volatility because confidence in smooth execution temporarily erodes. The halt acted as an accelerant to existing uncertainty rather than definitive evidence of manipulation. When headlines highlight that hundreds of millions of ounces of silver traded in a single session, it sounds dramatic. It sounds as if an extraordinary amount of physical metal suddenly changed hands. But that interpretation misunderstands how futures markets function. Volume figures in derivatives markets represent turnover, not physical delivery. Without that distinction, it is easy to misread normal market mechanics as something extraordinary. In the futures market, a single contract can be bought and sold repeatedly within hours or even minutes. Each transaction is counted toward total volume. If one participant sells a contract to another, and that second participant sells it again shortly afterward, both trades are recorded. The same contract may circulate multiple times throughout the day. This is similar to traffic on a highway. Millions of cars may pass through a stretch of road, but that does not mean millions of cars are parked there permanently. It reflects activity, not accumulation. Understanding this helps clarify what high volume actually signals. Elevated turnover during a volatile session indicates rapid repositioning. Traders are adjusting exposures, closing out risk, initiating new hedges, or responding to algorithmic triggers. In periods of uncertainty, such as after a hot inflation report or during geopolitical stress, participants tend to move quickly. That urgency translates into higher trading activity. It is also important to recognize that most futures contracts never result in physical delivery. They are financial instruments used for price discovery and risk management. Producers hedge output, industrial users hedge input costs, funds speculate on directional moves, and options dealers manage gamma exposure. The physical market operates alongside this financial layer, but the two are not identical in scale or structure on a daily basis. Misinterpreting volume as physical flow can fuel narratives that do not align with how markets operate. Large trading numbers alone do not prove coordinated pressure, secret operations, or artificial suppression. They demonstrate that a broad range of participants are active and that uncertainty is high enough to prompt engagement. In volatile conditions, rising volume often confirms that the market is processing new information. It reflects disagreement about value, which is precisely how price discovery works. Heavy turnover tells you the market is engaged and reactive. It does not, by itself, indicate manipulation or abnormal physical demand. Understanding that distinction allows investors to focus on structural drivers rather than being distracted by headline-sized numbers. One of the most overlooked structural factors in the silver market is how supply actually enters the system. Many investors assume that if price rises sharply, production can simply increase in response. In silver's case, that assumption does not hold up under scrutiny. A significant portion of global silver output is produced as a byproduct of mining for other metals such as copper, lead, and zinc. That detail matters far more than it appears at first glance. When silver is primarily extracted as a secondary output, mining decisions are not driven solely by the silver price. They are driven by the economics of the primary metal being targeted. If a copper mine is profitable, it operates regardless of whether silver prices are temporarily soft. Conversely, if copper prices decline and production slows, silver supply can contract even if silver itself is strong. This creates a structural lag between price signals and supply response. In markets where production is directly tied to price incentives, higher prices typically attract new investment, expand output, and eventually stabilize the rally. In silver's case, the response is slower and less flexible. New primary silver projects require significant capital expenditure, permitting timelines and multi-year development cycles. They are not switched on overnight. That delay tightens the supply side during periods of rising demand. Recycling adds another layer, but it is not an immediate balancing mechanism. Much of silver is embedded in industrial products, electronics, solar panels, medical equipment, where recovery is complex and not always economically viable in the short term. Even when recycling increases, it tends to respond with a lag, often months or years after sustained higher prices justify the effort. This supply structure becomes especially relevant when demand accelerates. If industrial consumption strengthens while monetary demand also increases, inventories can be drawn down more quickly than production can replenish them. In such an environment, price becomes the adjustment mechanism, not because supply has disappeared, but because it cannot expand rapidly enough to absorb incremental demand. The byproduct nature of silver production introduces rigidity into the market. That rigidity does not guarantee continuous price appreciation, but it does reduce the market's ability to quickly self-correct during demand surges. When investors evaluate the sustainability of a rally, understanding this supply constraint provides a more grounded perspective than focusing solely on short-term price movements. It is easy to focus on silver's role as a hedge and overlook the steady industrial engine working underneath the market. Yet industrial demand is not a side note, it is a structural pillar. When evaluating whether a rally has depth, the first serious question should be, is real-world consumption expanding, or is this purely financial positioning? Silver's industrial applications are deeply embedded in modern infrastructure. It is critical in electronics because of its unmatched electrical conductivity. It is used in circuit boards, connectors, semiconductors, and high-performance components that power everything from consumer devices to advanced data centers. As digital infrastructure expands globally, the baseline need for conductive materials does not disappear, it scales. Solar energy is another major driver. Photovoltaic cells rely on silver paste to conduct electricity efficiently. As renewable energy deployment grows, so does cumulative silver usage. Even when manufacturers reduce the amount of silver per panel through technological improvements, total installations can rise enough to keep aggregate demand firm. Efficiency gains do not automatically translate into falling overall consumption if volume growth offsets them. The automotive sector adds another dimension. Modern vehicles, particularly electric and hybrid models, require significantly more electronic components than traditional internal combustion cars. Sensors, battery management systems, infotainment platforms, and safety electronics all rely on conductive materials. As vehicle electrification continues, silver remains part of that supply chain. What makes industrial demand particularly important is its relative consistency. Financial flows can enter and exit quickly, creating volatility. Industrial users, however, operate on production schedules. They secure material based on procurement needs, not short-term price speculation. This creates a layer of demand that is less sensitive to daily headlines and more connected to manufacturing cycles. When monetary demand strengthens at the same time industrial demand remains firm, the market tightens from two directions. Fabricators still need physical supply, while investors seek exposure for macro reasons. That overlap can reduce available inventory more quickly than expected. It also means that pullbacks may attract buyers who view lower prices as opportunities to secure necessary inputs, rather than simply trade momentum. Assessing industrial momentum is therefore essential when determining whether a silver rally has durability. If production in electronics, renewable energy, and vehicles continues to expand, industrial consumption provides a tangible foundation beneath price movements. That foundation can support the market even when speculative enthusiasm fluctuates. It is easy to focus on silver's role as a hedge and overlook the steady industrial engine working underneath the market. Yet, industrial demand is not a side note. It is a structural pillar. When evaluating whether a rally has depth, the first serious question should be, is real-world consumption expanding, or is this purely financial positioning? Silver's industrial applications are deeply embedded in modern infrastructure. It is critical in electronics because of its unmatched electrical conductivity. It is used in circuit boards, connectors, semiconductors, and high-performance components that power everything from consumer devices to advanced data centers. As digital infrastructure expands globally, the baseline need for conductive materials does not disappear. It scales. Solar energy is another major driver. Photovoltaic cells rely on silver paste to conduct electricity efficiently. As renewable energy deployment grows, so does cumulative silver usage. Even when manufacturers reduce the amount of silver per panel through technological improvements, total installations can rise enough to keep aggregate demand firm. Efficiency gains do not automatically translate into falling overall consumption if volume growth offsets them. The automotive sector adds another dimension. Modern vehicles, particularly electric and hybrid models, require significantly more electronic components than traditional internal combustion cars. Sensors, battery management systems, infotainment platforms, and safety electronics all rely on conductive materials. As vehicle electrification continues, silver remains part of that supply chain. What makes industrial demand particularly important is its relative consistency. Financial flows can enter and exit quickly, creating volatility. Industrial users, however, operate on production schedules. They secure material based on procurement needs, not short-term price speculation. This creates a layer of demand that is less sensitive to daily headlines and more connected to manufacturing cycles. When monetary demand strengthens at the same time industrial demand remains firm, the market tightens from two directions. Fabricators still need physical supply, while investors seek exposure for macro reasons. That overlap can reduce available inventory more quickly than expected. It also means that pullbacks may attract buyers who view lower prices as opportunities to secure necessary inputs rather than simply trade momentum. Assessing industrial momentum is therefore essential when determining whether a silver rally has durability. If production in electronics, renewable energy, and vehicles continues to expand, industrial consumption provides a tangible foundation beneath price movements. That foundation can support the market even when speculative enthusiasm fluctuates. The phrase "last chance under 100" is powerful because it creates urgency. Urgency drives clicks, but it can also drive poor capital allocation decisions. In financial markets, round numbers carry psychological weight, and $100 for silver is undeniably one of those levels. The more important question, however, is not whether price can briefly touch that number. It is whether the market can accept and sustain it. A sustainable breakout requires confirmation. After a sharp upward move, the first test is what happens on the pullback. If silver retreats modestly and buyers step in quickly, that behavior suggests accumulation. It indicates that participants view dips as opportunities rather than warnings. On the other hand, if price spikes toward $100 and then drifts lower for days without meaningful support, that is often a sign of exhaustion rather than strength. The broader context also matters. If inflation continues to surprise to the upside and rate cut expectations remain uncertain, the macro environment provides a tailwind. Persistent pressure on purchasing power strengthens the case for holding hard assets. Conversely, if upcoming inflation data softens materially and central bank guidance shifts toward easing, some of the urgency behind the rally may fade. Cross-market confirmation is another key component. If silver pushes toward triple digits while gold stalls or weakens significantly, leadership dynamics may change. Watching the gold-to-silver ratio provides insight into whether momentum remains broad within the metals complex. Strength in related areas, such as mining equities and other industrial metals, can also reinforce the move. A rally that is isolated to one asset without confirmation elsewhere tends to be more fragile. Leverage and positioning further complicate the path. Rapid price appreciation often attracts speculative participation. While that can extend momentum in the short term, it also increases vulnerability to sharp pullbacks if sentiment shifts. Markets rarely move in straight lines, even during strong bull phases. Pullbacks, volatility spikes, and temporary reversals are part of the process. Triple-digit silver is plausible from a mathematical standpoint given current levels, but probability depends on sustained demand and macro reinforcement. The distinction between a breakout and a spike lies in follow-through. Durable advances are built on repeated evidence of support, not a single dramatic candle. Silver doesn't move in straight lines. It moves in waves driven by inflation, demand, positioning, and psychology. The real signal won't be the headline or the hype around $100. It will be how price behaves on the next pullback, how inflation evolves, and whether demand stays firm. Stay focused on structure, not emotion. Watch the data, watch the reaction, and manage risk intelligently. I'll continue breaking it down clearly as the story develops.